Thank you, Arun. Thank you for giving us a glimpse of what we can expect over the next 2 days. With that, we'll start with the conference. And to start, we'll start with one of the key aspects which is getting discussed, which is the pensions. Now, pensions, there's a lot of discussions around the pensions that is happening. There's a lot of changes that we're seeing in the industry. There's a heightened awareness from the customer's perspective in terms of the need for pensions to plan their retirements. There's a lot of increased competition from the pension management companies, and there's a lot of debate that happens in the political arena. Can I now request our chief guest, Mr. Supratim Bandyopadhyay, to come and present us the keynote address on the pension ecosystem in India. Please, sir.
Good morning, ladies and gentlemen. I'm very thankful to be here today, and I especially thank Mr. R. Arunachalam, President IAI, and the other members of the IAI for extending this invitation to me to be here today and present my perspective on the pension sector as it is in India today. All other distinguished guests, my friend and Chairman LIC, Mr. M.R. Kumar, Chairman GIC, Mr. Devesh Srivastava, Director NIA, Mr. Srinivasan, Mr. Arora, again, friend and member Actuarial IRDA, Mr. Dinesh Pant, appointed Actuary LIC, and all other distinguished guests from different international organizations. So it's a great pleasure and privilege for me to be here today. I've just completed 4 decades of service career. And out of that, almost 90%, 35 years, close to 35 years was with LIC, insurance industry, pure insurance industry. And thereafter, last 5 years, I had the opportunity to work as a member finance and chairperson of Pension Fund Regulatory and Development Authority, as you know as PFRDA today. So I'll be speaking from my personal experience as to what pension sector is today here in India, and possibly what are the scopes and what we can further do to extend it further. The journey of PFRDA started way back in 2004. And I consider it as a very, very strategic financial sector intervention of the government of that day. And it required a very big political will to bring that change, with central government employees being brought under a defined contribution pension system for the first time in this country. You must be knowing, and many of you may not know also, that earlier the DB scheme that central government employees were getting benefit of was a purely unfunded scheme. And over the years, a lot of benefits were also added. In fact, it's not known that the DB scheme as it is seen today and the kind of benefits that you see today for government employees, it was not like that earlier. Slowly, different layers of benefits were added, and that made it maybe more and more financially unsustainable. Initially, it started with a certain payout at the point of retirement, 50% of the last earned salary. Then was added the DA component, dearness allowance component, to keep it at par with the inflation. And then last, I believe, if I'm not wrong, maybe at the 5th pay commission revision, you know, pay commission revision comes every 10 years for government employees. 5th pay commission revision, The pension of the retired employees were brought at par in the lines of the revision that is being done today. So that was possibly the last straw. And thereafter, in the late 1990s, around 99, 2000, certain committees were created, Bhattacharya Committee, Oasis Committee, and all that. And they found that the system has become really unsustainable. And if we do not come out of it, possibly we are going to face a very big financial debacle. And again, as I said, it required a lot of political will of the government of late Sri Atal Bihari Vajpayee ji, who brought in this scheme with effect from 1st January 2004. A lot of issues we are facing now, last 1 year. I believe there is a session on that in the second half. I'll not touch it in detail, but before I end, I'll talk about that in few sentences. Initially, as I said, it started with 1/1/2004. That was the cutoff date. Employees, those who came thereafter, they were necessarily under DC scheme with 10% contribution from both sides. Thereafter, successive governments brought in all the state governments excepting two, West Bengal and Tamil Nadu. People know that Tamil Nadu is not a part of the DC scheme, but they do not know maybe there is another fact that post 2003, Tamil Nadu state government is not giving the DB benefits to their employees. So they have deducted in the lines of DC, that we call it NPS, National Pension System. They started deducting 10% of their salary. They were also contributing 10%, and that money is getting invested separately. And every year they add the GPF, the Government Provident Fund rate, which currently is at 7.1%. But it does not really ensure a pension. When the person retires, the entire corpus is given back to them. But one good thing Tamil Nadu government has done is that they have not continued with the DP, which West Bengal continued with. In 2009 came a change when this NPS, National Pension System, was extended to individuals, retail customers, as well as corporates who are bringing their employees in a group. And this is the segment which is growing now. In 2015, another scheme was added, another product was added. That was sort of a mixture of defined contribution and defined benefit. It's known as Atal Pension Yojana. And that scheme ensured that to some extent, especially in the unorganized sector, they get the benefit of pension. The maximum pension that is ensured is about 5,000 rupees a month, not more than that. And it starts with 1,000 rupees a month, then it goes into 2,000, 3,000, 4,000, and 5,000. And with a defined contribution, you get that defined benefit. And if there is a shortfall at the time of annuitization, that the government will bring in. The annuity rates, which was guaranteed at that point of time, was 7%. Fortunately, now with the hardening of interest rates, as we have seen, the annuity service providers, they have rejigged their annuity rates higher, much higher, and there are still companies who are giving close to 7%. But there was a time when the annuity rates fell to almost close to 6% or less than that. We do an actuarial valuation on this fund, APY fund, every year, since it is a guaranteed fund, and share it with the Government of India. And recently government has agreed and they have just starting the gap funding process. So to see that the product and the benefits are protected. What is the situation today? We have about 62 million customers, as I am talking to you today, and close to $120 billion of fund, which translates to roughly around 9 trillion rupees. Out of that, pure NPS will be about 15 million people, and balance 47, 48 will be with APY. So this APY has really caught up, and to some extent, I am not telling that this is really giving a huge benefit and a lot of people are still covered, but with every passing year, we are covering more and more people. Like this year itself, about 11 million new customers have already joined by the end of February, with 1 month still to go. When this entire NPS system was thought about, it was a total unbundled structure. Each entity was given a particular job to do. It's not that, like today you see in mutual fund industry or insurance industry, a particular company is given license, they not only market the product, they create the product, manufacture the product, they manage the claims, they do everything thereafter. All the after-sales service, everything that they give. But here, we created different entities to handle different activities, like fund management with fund managers. Distribution channel is separate. Data keepers, separate. There is a particular bank through which the funds will flow. There is a valuation agency separately. And like that, it went on, but it is still, there are 6 to 7 different entities, but they are working seamlessly. And the accounting method that fund accounting method that we had chosen, of course, was mark to market. So every 24 hours, the fund manager's performance is judged, and it is absolutely market related. As I said, now what we see that more and more customers are coming from the corporate sector, where the corporates with their employees are joining NPS, or individuals who are coming. That apart, when we have seen the pension sector of India, the biggest challenge that came to our mind was that it is too fragmented. If we talk about retirement benefits, not pension, but in a broader term, retirement benefits, there are many organizations, many institutions which are providing those kind of benefits. Whether it will really give a regular income post-retirement, that is not sure, but they are giving some kind of retirement benefits. The oldest one, of course, is EPFO, Employees Provident Fund Organization, started in 1952. They added a layer of pension called EPS in the year 1995. Recently, there is a very good development post-Supreme Court decision that they are changing the pension levels, but there was a point of time when people were not getting a pension of more than 6,000 to 7,000 rupees a month. Because the contribution was capped, irrespective of your salary, you cannot make a contribution beyond 15,000 rupees a month. That was taken as the salary for the purpose of EPS. Then, of course, there are other special provident funds for different kinds of employees, coal miners and Assam tea planters and all those things. And then there is obviously the insurance industry, which played a big role. And insurance industry, of course, they manage both in group and individual level, both deferred and immediate annuities. And then came PFRDA at a later stage. So all taken together, we are looking at what was the fund size, just out of curiosity. It is not more than 36 trillion rupees for a country like India with a GDP of more than 3 trillion rupees. So it hardly works out to 12 to 13%. And if we look at the OECD countries, the average roughly works out to 100%. There are countries, I've seen whether GDP to pension asset ratio is twice, pension asset is twice the GDP of the country. So that leaves a feeling that we have a lot of catching up to do. When we look into the data points given by many other studies, like one Mercer has done, Mercer CFA Institute Global Pension Index. I believe that is one of the most authentic studies that I have come across. They have done the analysis of pension sector of 44 countries, and again, India is coming at the 41st. Two major parameters where we are missing out really is the adequacy and the sustainability. Whether what we are giving is adequate and can we continue for a long period of time that a pension scheme is supposed to do. Here we are really missing out. And as a result, we are coming into the 41st position. Though the last parameter, integrity, we are still better. We are little over 60 in the index value terms. Argentina, Philippines, and Thailand, they are keeping us company. They are the 42nd, 43rd, and 44th. If we look at the younger generation, what happens? We had the occasion in these 5 years that I was there to talk to people in general, industry bodies, through many forums and all that. What we come across, that people do not want to talk about pension and retirement. They feel that this is something maybe 3.5 decades afterwards. And as a result, everything gets postponed. I have come across recently a very interesting study done by Max Life Insurance with Carvey Insight. Jointly, they have done a study, mostly on urban population in India. And few of the interesting outcomes which I have come across, I want to share with you. 35% of people never invest in any financial product for retirement. And you know why this, they deter to go and invest? Is that the biggest barrier is they feel that their children will take care of them. And the second thing is that they have enough family wealth. And interestingly, 20% of this population on whom the survey was conducted, they feel that they are never going to retire. So this is the thinking. 65% of the people, I believe, 56% of the people who have crossed 50 years of age, they feel that they should have started early, and whatever they have accumulated as a retirement corpus, this is going to be wiped off completely 10 years after retirement, within 10 years after retirement. So they are going to outlive the corpus that they are going to create. A large number of people, 85% of the people, they feel that they are going to stay with their children post-retirement, but look at their own lifestyle. 75% of them, they are staying in nuclear families. So, which is the reality, which is the myth, it is very difficult to understand, but we always feel, and a large number of people, I believe 75%, they feel that they are going to lead a very healthy life post-retirement. And 70% of these people who are thinking like that, they have not done any health checkup in the last 3 years. Many other interesting data, but I do not want to bore you with all these kind of outcomes, but this is the reality that we are going through. I believe we have long way to go and a lot of things to be done. I've gone through the IRDA annual report 2022, latest one. There I found the total pension assets, which includes pension and group and annuity, as they call in that particular group. The total assets constitute little over 23% of the total assets under insurance industry, life insurance industry, which has life fund and the ULIP fund separately, all taken together. And the total pension assets will be somewhere around little over 11.5 trillion rupees. And again, interestingly, 87% of that is with a single insurance company. And balance 13% is again coming from 20 other insurance companies, life insurance companies. I think there is some anomaly there, and we have to correct that anomaly and see that people really come and ask for a deferred annuity as a product of their choice. What can we do about it? Yes, this is the forum. I thought I'll bring it out before you. You are experts. You must look into it, what kind of innovative products you can think of. So far as the deferred annuities are concerned, because again in PFRDA, it's a sort of a unique kind of regulatory body where we only manage the accumulation phase. Whereas when the decumulation starts, the actual pension starts, or when we say it's the moment of truth, then they go over to annuity providers, which are obviously under IRDAI. 14 such annuity service providers are already empaneled with us. All the top names are there with us today. But when you look at the rate and the differentials in the rate under the same kind of product, so we find a huge difference. Already about 1 lakh people, they have got annuity from the NPS. They have come out, maybe some early exits and all that. And there we find that 96% of the people, they have chosen just one product. Joint life with return of purchase price. Possibly the costliest annuity product available. Maybe they were not guided. Because if they are guided properly, maybe they will go for a joint life without ROP. And again, within the same product, like joint life with ROP, if you see at the two extremes, what are the differences like? I was looking at the latest rates. You won't believe it is as high as 190 basis points. Yes, there can be variation in actuarial assumptions, I understand. But what else can be there to make the difference so large? So I believe some kind of hand-holding also at that point of time is required. And so far as the annuities are also concerned, the immediate annuities are also concerned, they are also, can we think of products like whichever is going around in other countries, variable, which can be linked to some market benchmark, fixed indexed kind of thing with a floor and a cap, and all these kind of innovative annuities. Can we really look at these things? Because that will give a choice to the person at the point of retirement. Otherwise, it is not giving a choice, and everybody is looking for just one product. And they really do not know whether that is right for them. Before ending, I just wanted to touch about that disturbing development that we have seen. And as I said, that you also have very thoughtfully kept one session on that, is that there is a mass scale sort of effort to go away from DC schemes to old DB unfunded schemes. Already 4 or 5 states, they have stopped contribution. They want to go back to their old DB schemes. If you go through the RBI latest report, I think it came out in June 22, on the state finances, you will see the situation that every state is going through. One thing is to compare their expenses to their GDP, gross state development product. But if you take their own revenue and the committed expenses as a percentage of their own revenue, it will be quite revealing. How much percentage of their own state-generated revenue they are spending on committed expenses. What are the committed expenses? Obviously, salary, pension, and the loans on the borrowings, state loans that they have borrowed and which are necessarily to be paid. In some states, it is more than 70 to 75%, which is really scary. And still they are promising. I really don't know why they are want to go back. Maybe it is a political compulsion for them, but that is not auguring well for the country as a whole. And I am reminded of that great quote, the great saying of Mahatma Gandhi ji, what he said to the Cripps Commission when they promised to give India sovereignty after the Second World War is over, with the condition that India will help the British. He said it is like accepting a post-dated check on a failing bank. So I believe it is the same thing that the state governments are doing, promising a post-dated checks on a bank which is bound to fail. So I believe in this forum, if this kind of discussion starts, and all you professionals talk about that at great length, and it comes out in the market, slowly maybe the awareness will come. And people will now know what is good or what is bad for them. A lot of things are to be done about the pension sector, but I believe the best thing that we can do is to bring in little more focus there. Because we are talking about Amrut Kal, we are talking about 100 years of our independence, a great thing which will happen in 2047. But by the time we reach there, there will be 2 billion senior citizens across the world, and out of that, at least 330 million will be there in India. What we are going to do about them? So the choice is before us, whether they are going to become a burden on the society or the government of that day, or they are going to really make a significant contribution to our economy, which in many countries they call the gray economy. Whether we are going to make them a significant part of that. So the choice is before us. Thank you so much for calling me here today and giving this time to speak on this burning issue. Thank you so much.